U.S. Federal Reserve Chairman Jerome Powell said Tuesday that high inflation figures will likely delay any rate cuts until later this year. His latest remarks signal a period of higher for longer rates. Our Seung-jae starts us off.
The U.S. Federal Reserve has long kept its inflation target at 2%. Reaching the target would mean rate cuts to levels seen before the COVID-19 pandemic. However, speaking at an event in Washington, D.C. on Tuesday, U.S. Fed Chair Jerome Powell hinted that it will take longer than expected to achieve the confidence needed to reach the central bank's inflation target, signaling it will also likely take longer to cut rates.
The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. That said, we think policy is well positioned to handle the risks that we face. If higher inflation does persist, we can maintain the current level of restriction for as long as needed.
Powell's latest comments are in contrast to remarks made just 2 weeks ago, when he said the overall outlook had not changed much despite some hotter-than-expected figures at the start of the year, and that central bank officials expect to lower rates at some point this year. His comments also suggest that without further evidence of inflation falling, the U.S. Fed may carry out fewer than the 3 quarter-point reductions forecast during its policy meeting in March. U.S. stocks reacted negatively on the back of Powell's hawkish comments. The S&P 500 dropped below 5,100, shedding 0.21% to end trading on Tuesday at 5,051.41, while the Dow Jones also fell 0.53%. The tech-heavy Nasdaq fell 0.12% from the previous day. Rate cut delays in the U.S. will also mean a more restrictive stance by the Bank of Korea, with South Korea also struggling to bring down its inflation level to the 2% target. Seung-jae, Arirang News.